On one wrist, a $1,500 mechanical watch that whispers tradition. On the other wrist, a $500 wrist computer logging every heartbeat. This is not a taste story. This is the watch industry's new reality. Swiss exports just plunged over 50% in America. Consumer demand is fragile, and luxury now faces a reckoning from tariffs, prices, and tech. Who loses? Who adapts? And where does this squeeze bottom out? Swiss watch exports fell sharply in November 2025, dropping 7.3% to roughly 2.2 billion Swiss francs, the Federation of the Swiss Watch Industry, FH, reported. Visual. Show an export chart with a bold call-out for 7.3% and 2.2 billion Swiss francs, split screen with a macro of a movement to sell the contrast. The change here is sharp. But the real jolt came from the United States, where exports collapsed 52.3%, down to 201 million Swiss francs in a single month. Visual. Highlight the United States on a map and flash a headline noting U.S. exports down 52.3%. This was the jolt that turned a single-month drop into a global story. These are not retail sales. They are shipments out of Switzerland, shipments that move from factory to border. Export figures capture that flow, not what actually sells in a boutique or online. Visual. Factory packing lines, pallets being loaded on trucks, then an empty boutique display to underline the difference between shipment data and sell-through. From January through November, the cumulative decline sits at 2.2%, erasing much of the modest growth seen earlier in the year. Visual. A year-to-date timeline showing growth earlier, then the decline, with a simple label reading 2.2% cumulative decline. The pattern is cumulative, not random. The Federation of the Swiss Watch Industry called out the United States as a major driver of the November downturn. This is not just one bad month in one market. When the biggest luxury watch destination pulls back, it sends ripples through suppliers, distributors, and inventory planning across the industry. Visual. Supply chain. Ripple animation, vendor invoices, and a retailer looking at inventory reports. Deloitte's 2025 Swiss Watch Industry Study paints a similar picture. Executives describe demand as fragile, tariff uncertainty is weighing on decisions, and price sensitivity is rising. Even so, some segments show nuance. The 200 to 500 Swiss franc range posted growth, while most other categories are shrinking. Visual. Side-by-side price band chart. Highlight the 200 to 500 Swiss franc segment up, others trending down. The signal here is mixed, but leaning negative. The data is clear. Cost pressures, economic anxiety, and shifting priorities are squeezing the market from every angle, and the numbers do not leave much room for wishful thinking. The question now is not whether the pressure is real, it is how deep it goes, and who gets squeezed the hardest. Visual. Showroom shots, commuters checking a smartwatch, scrolling pre-owned listings, and a close shot of a price tag being marked down. If you are into breakdowns that follow the money, not the marketing, hit subscribe. I am tracking what is really happening to watches in 2026, and the numbers do not lie. Now, how did the industry end up in this squeeze? The story breaks down into three clear phases. Phase 1 is the post-2020 boom. With travel off the table and markets flush with cash, watches became the hot ticket. Social feeds filled with waiting lists and record auction prices. Brands leaned into the hype, pushing limited editions and creating a real sense of scarcity. For a moment, it looked like the party would never end. Phase 2 is the premiumization playbook. Prices climbed, sometimes faster than buyers' incomes. Scarcity marketing trained shoppers to see watches as investments, not just accessories. Suddenly, a stainless steel sports watch felt like a portfolio move, not just a birthday splurge. Brands got comfortable raising prices, and the buyers who could still play kept chasing the next big thing. But beneath the surface, volumes were already slipping. Fewer units moved, but at higher prices. The industry started to feel less like a community and more like a stock market. Then came the come down. Everyday costs went up, and interest rates stayed high. That same buyer who once stretched for a luxury piece started feeling watch fatigue and noticed that their Apple Watch or Garmin handled daily life just fine. The average consumer's priorities shifted. Health, payments, and notifications edged out mechanical prestige. The result is a market that is more vulnerable than it looks from the outside. When pressure hits, whether from tariffs, economic headwinds, or shifting tastes, the cracks left by those earlier choices get wider. And that is exactly why the next hit, like tariff whiplash, lands so hard. Tariff policy has become a game of high-stakes guesswork. When the United States slapped a 39% tariff on Swiss watches in August 2025, brands scrambled to protect margins. Price lists were rewritten almost overnight, with some U.S. retail prices jumping by double digits. Then, just as quickly, a framework agreement on November 14, 2025, rolled those additional tariffs back to 15%, retroactive to that date. B-roll suggestion: news headlines about tariffs, graphics showing 39% to 15% with the date November 14, 2025. That is where the problem gets real. Brands faced a simple dilemma. Do you roll back the price hikes, or keep them as a buffer against more policy swings? Most chose the cautious route. 15% is still much higher than the pre-2025 baseline, and with the United States setting a March 31, 2026 deadline to finalize the deal, or risk another reversal, no one wants to be caught out. This uncertainty changes behavior at every step of the chain. B-roll suggestion: authorized dealer showroom shots, stock arriving in boxes, price tags on screen. Authorized dealers are left holding inventory bought at the old higher rates, with new stock arriving at mixed costs. That creates confusion at the counter and thinner margins for many retailers. Discounting appears, private sales and incentives creep in, and the gray market gets noisier. The so-called uncertainty tax is not just a line on a spreadsheet, it is baked into every new MSRP, and it rarely comes back down once it is in place. Smartwatches are quietly winning the daily wrist battle, and the numbers back it up. Counterpoint reports global smartwatch shipments jumped 9% year over year in the third quarter of 2025, and full-year projections are up 7%. That is not a blip. For many buyers, the practical choice is shifting. A $399 device that tracks workouts, sleep, payments, and messages starts to look like a smarter use of a limited budget than a traditional mechanical watch. Health and fitness features are not just marketing, they are a core reason people reach for a wearable. Once someone is in the Apple or Garmin ecosystem, the convenience becomes hard to leave. For a growing share of consumers, especially those making tough spending decisions, the mechanical watch becomes a second purchase, not the default. This is not about snobbery or taste. It is about wallets moving toward value they can use every day. The shift is real, and it is showing up in the sales data. Not every watch brand is feeling the same pain. Inside the export numbers, the Federation of the Swiss watch industry points to a telling detail. The 200 to 500 Swiss franc price band actually grew, while nearly every other segment shrank. That is not a rounding error. It is a clear sign that buyers who still want a Swiss watch are gravitating toward affordable, entry-level models. For everyone else, especially in the mid-tier and above, the story is much rougher. Higher price points, those once seen as the sweet spot for aspirational buyers, are now caught in a squeeze. They are expensive enough to make people hesitate, but not exclusive enough to feel truly special. The result is a split market. Value-driven models keep moving, while the brands that relied on stretching budgets are losing ground. This divergence is not just a blip. It is turning the industry into a two-speed world, where survival depends on which side of the price line you land. On one side, ultra-high-end brands with true scarcity are still selling. Watches that sell out before they hit the case keep moving, because those buyers are after exclusivity, not discounts. Interest rates matter less when the purchase is about owning something rare. At the same time, companies that built strong after-sales and certified pre-owned programs are seeing steady business. When retail prices feel risky, buyers look for value and trust, and the best pre-owned operations deliver both. Service and warranty matter now as much as the watch itself. Service-centric brands keep clients loyal even as new sales slow. For entrepreneurs in the secondary market, this is an opportunity rather than a crisis. If you can guarantee authenticity and reliable support, demand is waiting. On screen, show a split screen with smartwatch metrics on one side and a mechanical movement macro shot on the other. Then cut to pre-owned listings scrolling, a service bench, and a trade-in desk. Mid-tier brands and retailers are feeling the squeeze. Aspirational price points that once tempted budget-stretching buyers now sit on shelves, forcing authorized dealers to quietly discount or bundle just to move inventory. The consumer squeeze is not just theory. Nielsen IQ reports more shoppers are delaying big-ticket purchases, picking essentials and utility over status. Expect more certified pre-owned deals, creative financing, and a marketing pivot from investment to emotional value. Retailers without a pre-owned or trade-in strategy risk being left behind as 2026 unfolds. For watchmakers, the crisis is not about nostalgia. It is about value when every dollar counts. As tariffs, technology, and tighter wallets reshape the wrist, only brands that adapt will earn their place. The future is not promised to tradition. It belongs to whoever proves their worth, one buyer at a time.